Welcome to the August edition of the Beginner Algo Trading series. Today we are going to talk about gap opens based on some information that's publicly available on the internet. And then in the video following this, we'll talk a little bit more about the second point after prove the edge, the quantify risk element, because I'm going to talk about Monte Carlo analysis, Monte Carlo simulation, what it is and why that's useful. So I'm not going to go over this slide because it's shown in pretty much every video, and I cover it today. Again, we're going to talk about gap ups and behavior of an instrument following a gap up. This is one thing that you should always be aware of for whatever instrument you're trying to trade, whatever market you're studying. Definitely see if there are any trends. It's sort of like a good follow-up to seasonality, where we're looking for common patterns based around seasons, whether it's holidays or months or day of the week. Gap ups are kind of adjacent to that in terms of seasonality. Many markets have consistent behavior following a gap open on the daily chart, obviously. And there are ways to take advantage of them both for intraday trading as well as the daily chart trading that I'm teaching in this series. So I'm presenting a gap up strategy as well as some data in today's video. And it's something that you definitely want to also analyze for whatever instrument you're developing for. And then, as I mentioned previously, in the next video, I'm going to talk about Monte Carlo simulation and analysis. Okay, so let's talk about gap opens. There are a lot of websites on the internet that have data on gaps for SPY. And because we are trading daily charts, we can't actually take advantage of any sort of intraday behavior. But it is out there if you want to see common patterns based on whether the day opens as a gap up, gap down, and then most importantly, what the percentage of that gap is if you're intraday trading. But for what we're doing, we're going to simply see if there's an effect that occurs in the US equities when it gaps up. So this is probably the best summary I could find. I just had basically ChatGPT analyze several websites that did studies on SPY, and effectively right here it says if you are trading intraday, there is a mild tendency to fade a small gap. In my personal experience, the larger the gap, the more likely that momentum is going to continue. Whereas if the gap is not very large, it's likely to be there's likely to be profit taking, and it's good for fading. However, this second point here is what I want to focus on because we are trading daily charts, and so we care about daily bars. So therefore, next day performance, as well as the performance of 5 days out, 3 days out, that can matter. And based on what ChatGPT could scrape off the internet, it has effectively said that usually, even if SPY was to give up the gains from the gap up, historically, the day after that, it goes higher in 64% of cases. And also, if the gap is large, then there tends to be large gains following that gap as well. So I didn't show the sources, and that's quite frankly because the list of sources was quite long. You can do a quick Google search for this, behavior of SPY after a gap opening. There also is some behavior around gap downs, but for the sake of this video, I just wanted to present gap ups. You can also think of it as the market trend continuing in SPY. So let's analyze this idea. And again, I just want to mention that the internet is full of trading ideas. Most of the ideas, or at least trading ideas that are specifically written on the web, and I mean like labeled trading ideas or trading strategy, most of those will usually not work as written because by the time it's being shared and publicly posted, its edge has largely eroded. And so it might just, in my experience, is usually something that only turns into a beautiful back test, but then you look at the end of that back test and you realize that the performance has gone sideways or perhaps even down recently. And so that's partly why they gave away for free. or post it publicly or whatever. But for things like this, what I just showed you is not necessarily a trading strategy. Rather, this is just some consistent behavior that's been analyzed in SPY based on gap openings. So what we want to do here is first analyze just buying the day that has a gap opening. So that is just is the open greater than the high of the prior day. So that's a gap up, and you'll see that technically this has made money over time, but the profits are probably just from the long bias of SPY, the upward trend of SPY over time. And you'll notice that a lot of these drawdowns, these huge spikes down, are very big. And so just entering long on the close of any bar that gaps up, and then exiting when a day closes higher than the prior day's high, which if you've been watching this series, you know is one of my favorite exits on the daily chart. So you'll see there that this is not a particularly great strategy. So our goal here is to see if we can improve the profit factor. The 70% profitability is quite nice. It just means that the majority of the losers are huge, like massive losers, and you can see that with the max equity drawdown being around 10%. I'm not a fan of a single strategy having a max drawdown of 10%. I'm okay with my overall portfolio of strategies has a max equity drawdown of 10%. But just one strategy in that portfolio hitting 10%, unless it gets balanced out by other stuff in the portfolio, which sometimes happens. Usually when I see that big of a drawdown, I think of, okay, well, there might be a way to further improve the strategy, or maybe we shouldn't be running this strategy in the portfolio. So the key thing I want to point here is that we have about 1,000 trades in this back test, and this back test is since the beginning of SPY. And we have about a 43% return. And so what we can do here is obviously we need to add a filter. So that, this one is just buy every bar that gapped up, by the close of every bar that gapped up. So the first filter I like to add, which you might can guess if you've been watching this series, is just check if the bar closed near its low. This has historically been one of my favorite filters to add on the SPY daily chart. And so here are the rules. It's the same thing as the first version, except now we just check, did that day that gapped up, did it close in the bottom 20% of its range? So now if we look at this result here, we see more than a doubling of that profit factor. The win rate has gone up to 75%. And we have about only 1/4 of the total trade. So we went from about 1,000 to 264. The drawdown went from about 10% to 3.68%. And I mentioned that the original strategy had about a 43% return on the account. So this one has about a 42% return on the account. So we sacrifice about 1% of the total net profit for a higher win rate, for less trades, a lower drawdown, and overall just being less in having less time in the market, which again is good because we've so far in this series have developed 7 other strategies, and we need to have capital allocate or to be able to trade those strategies. And so we don't want any single strategy hogging up too much of the portfolio space or the capital allocation, because that just means that we're pretty much relying on the upward bias of SPY at that point, and we're not actually capturing much edge anymore. Whereas having strategies that don't trade as frequently but have very strong profit factors means we're capturing a very strong edge. And by combining all those together, or several strategies like that together, we can get outsized returns that more than beat buy and hold, and also more than beat the majority of retail traders. So this is where I'm going to end the video today. I'm not going to show a coding video because I'm sure that you can, if you've watched this series, you can easily code this simple strategy that is quite good. Honestly, if you just traded this by itself, you'd probably do very well. And so, yeah, definitely examine gap ups and gap downs for whatever instrument you're trading. If you decide that you're going to trade this strategy, which I personally like, I trade a slight variation of this strategy in my own personal portfolio. I would also recommend that you look at gap downs and try to see if there's any sort of consistent behavior there as well, because that's another way to just add another complementary strategy to your portfolio if you can find something there. But yeah, thank you for watching this series so far. And I definitely recommend you watch the next one because it's one of the most important. Monte Carlo is definitely the one of the gold standards, I should say, in terms of analyzing a backtest and deciding how you want to take it live, what you should position size, and how much money to allocate to that strategy, and just a number of other things as well. So definitely watch that if you have no idea what Monte Carlo is, and even if you do have an idea of what Monte Carlo is, I recommend that you still watch it because there are some applications of it that I show that you may not have seen before.